What's going on, guys? Brian's here. Today is Tuesday, February 6th, 2024, and the market is currently open. It's power hour. The market closes in a little under 50 minutes, and this is a live position in which I'm currently in. It is a double calendar using a 0 DTE expiration. This is my live risk profile right now on Thinkorswim. I'm in 3 lots of the double calendar. The position is currently up $321, and let's just head over here and increase the lot size just so you guys can see that it matches up here. So let me just increase this. I like to save things on option strat as one lot because it makes it easy to scale up or scale down for the next time as I'm journaling. I take notes of what the Greeks are when I open the position. So the next time, if I'm running 10 lots, if I'm running 6 lots, it makes it easy to just standardize the positions over the long term. But in this case here, let's just increase this to 3 so you guys can see this is how much margin is being used on the trade. This is the max profit for the day. And throughout the duration or the lifespan of the trade, I take notes. I open it around 11:30 here today, and I take notes. So about 45 minutes after I open a trade, a little bit after, a couple hours after I've opened a trade, and then just at the start of power hour, which is when I decided to just hop on and record this video because I figured this might be some information that's pretty valuable to you guys. A calendar inherently is going to benefit from an increase in implied volatility for your long expiration. If you don't know what a calendar is, it is a combination of selling or shorting one contract and then buying that same expiration at a further out in time. Obviously, when I say one, you can scale up or scale down. But for the basics or learning, this is just saying we are shorting that 49.50 call for this date, so February 16th, and then we're simultaneously buying the 49.50 call for a further out in time date. The reason we open this is because time decay is going to be eating away at the option that expires closer to expiration. So obviously February 16th is closer in time to right now than February 26th. So the time decay is eating away at this option faster than it's eating away at this option, and that's going to create a curve right here, or a tent that it's commonly called, and this is your profitability zone. So as long as price is within this tent, you're going to be profiting, and this is the P&L at expiration. This is the lifespan of the trade. This is what's referred to as the T+0 line. So as time passes by, that's what your theoretical P&L will be. However, implied volatility affects the trade. If implied volatility contracts, then so will your profitability zone. On top of that, if the implied volatility increases for your front month, so the option that you are short, in this case, this is our front month right here. In this hypothetical example, if implied volatility increases for that month, you guys can see, so can your profitability zone or your T+0 line. So that makes calendars very sensitive to changes in implied volatility. However, when you're running a 0 DTE calendar, you are capitalizing off of the fact that the 0 DTE option is going to be getting chewed up by time decay. And that's reason number one as to why would I even consider to run a trade like this. It's because I was not expecting much movement in price. This is the SPY for the day. As you guys can see, it's been pretty choppy, and I'll walk you guys through some of my thoughts here a little bit earlier in the day. But let's just jump to take a look at the ES for a second. This has been some demand zones in which I've had on my charts, just taking a look at the volume profile. There's also this one trend line that I've had on my charts ever since it started forming a couple weeks back, and then I've just been extending it and so forth and watching as price action has traded around it. On top of that, we have some point of controls that are slightly under, and every time the SPX or the ES has reached any of these demand zones, we've seen some sort of a bounce, or we've seen some sort of choppy consolidation in price action around these significant levels. So at the start of the day, I wasn't really expecting much movement for the markets. However, I waited at least an hour before even deciding to take a trade because I wanted some additional confluences. The additional confluences in this case came with the gamma exposure. So this purple level that you guys see on my chart right here, this is the absolute gamma strike for Friday's expiration. And if I were to just turn on some of my notes at the start of the week, if you guys are new to this YouTube channel, I'll leave a link in the description to the gamma exposure playlist, in which I've covered gamma exposure many times, and I've also shared what I like to do or how I start my week by plotting out my levels on my charts taken from the gamma exposure profile. So it's taking a lot of the discretionary or a lot of the bias out of where these levels are coming from. Instead of trying to plot levels on what I think is support and resistance, I'm just plotting levels that are coming straight from the options chain on my chart, and it's letting me know that these are going to be key inflection prices, or they're going to be areas of high liquidity. By key inflection, it means if price comes down to one of these zones and we find additional confluences, we are likely to see some sort of a reversal. If price is around these major strike prices, we're likely to see some sort of choppy price action. I've done many videos on this in the past. You guys can check out some of the previous ones in which I go into further detail. So my thought process being, hey, If we were to turn off these levels here and just look at a clear chart, I already knew this is the absolute gamma strike for Friday expiration on the SPY. So that's 493. And then on top of that, at the start of the week, when I draw out these levels, this was also the last strong positive gamma exposure strike. If we jump over to the Quant Trading App Discord, this was earlier in the day here today. So this is just a feed of the gamma exposure changes on the 0DTE SPX options throughout the day. So a little around 11:15 as I was taking a look at this was the current spot price for the SPX. And then I was taking a look at this and I was noticing that there wasn't really that much aggressiveness I was seeing in the profile compared to previous days. If you've been trading with gamma exposure, after a while, you tend to just be able to just take a look at it and see when one side is being more aggressive than the other. Let's just say I was seeing some really huge green bars all the way up here and then another one really far up here, and price action wasn't coinciding with this, and we were seeing some really aggressive buying. The SPY was staying above VWAP all day. Then I'm definitely not going to run a non-directional trade like a double calendar. I'll probably just go with an out the money butterfly spread or something like that. But because this profile looked pretty flat, or even on both sides, this is pretty flat up here, this is relatively flat up here, spot price is right in between the two, I don't really have much of a directional bias. I'm just thinking price is either going to head to here or it's going to head to here. I have no idea which way it's going to head. And because of that, I'm going to consider mocking up something like a double calendar. In other words, if price was to go up here or if price was to go back down here, it really doesn't matter to me as long as it doesn't go too far. So as we take a look at the live P&L right here, you guys can see the call side was 49.50 and then the put side, as we can see right here, is 49.25. So that's right down here. Those are the peaks of both of my tents. So this is where there's max profits at the close of today. If price remains in between, this is where the profit is going to vary or bounce around. As you guys can see, it is changing here. So I'm just going to slide this. This is if the market was to actually move a little bit. You can get a theoretical representation of your P&L, but let me actually just reset this to make sure it is at the right strike price. And then let me just remove the slices. So we're just paying attention to the live price right now of the SPX. This is our live price. This is where the SPX is. Again, this position expires now in about 38 minutes or so. So I have to make a decision here, or I can let it expire. Obviously, I'm not going to do that. I like to close these positions out around 15 to 30 minutes before the market closes, just because anything can happen after hours, and SPX options are actually trading 15 minutes after the bell closes. Don't like to take that type of risk. So I will be closing this out probably as soon after I'm done wrapping up this video. Now, something I want to point out is when I open the trade, TIV right here is just what Thinkorswim was saying was the implied volatility for my front month. I like to take note of that. And as you guys can see, that's the Thinkorswim implied volatility for the front month. So my front month is the 0DTE. So February 6th was around 18.15%. That's at the time in which I opened the trade. Then about 45 minutes or so, implied volatility increased for the 0DTE, and that is often what happens. The back month also increased a little bit. My profit actually ended up jumping pretty high, and this is usually where I would just take profit on a position like this, because as you guys can see, I've been holding the trade now all the way until power hour. So it's been over 3 hours, and the position has fluctuated from 7.6% early in the day to being up 12% now. Yes, this is more than earlier. However, it was up 11% a little bit after lunchtime here. So sometimes it's not worth it to hold for that extra couple percent. I believe the max profit this position can actually make by the close is around 20, let's see right here, 30%, but that's probably going to decrease a little bit because tomorrow's implied volatility will decrease a little bit if the SPX was to push up a little bit more. Just another 5 points or so is what's needed for max profitability, and obviously it needs to close up there. But for the most part, as you guys can see, you're generally going to be targeting or aiming for around 8 to 12%, anywhere within that sweet spot. If you're capturing about almost an 8% return in less than an hour, you might as well take your profit if you're trading 0DTE calendars because of how sensitive they are to implied volatility. Just take, in other words, the quote unquote easy money when you're in something like this quickly. I took note of here, this is actually supposed to say 49.39, not 39. Obviously, the SPX was not at 39.39 today, but 49.39, the position was open at 49.40. So the SPX moved about 1 point in over an hour, and you guys can see that the P&L actually decreased. It went from being up plus almost 8% to being up only plus about 6%. So even though price barely moved, the implied volatility decreased for the back month. So when I opened the trade, implied volatility for tomorrow was 14.11. Now it's only 13.94. So even though the market barely moved, which is really good for a calendar because it is a theta positive trade, in other words, it's long theta, it benefits from the passage of time as long as price prices remaining within the tens. This is a case here where you can have that, but you're still not really going to be making more money. And that can be frustrating when you first start out trading calendars. Why is your P&L not going up, even though more time is passing by, especially if you're trading a 0 DTE? And that's because the implied volatility for tomorrow's expiration, or you're further out in time. I could have went with a Thursday expiration, even a Friday expiration. The implied volatility is likely to also decrease if the market is doing this, going absolutely nowhere. Of course, if there's expected events on the horizon, let's just say tomorrow is an FOMC report, then that can change or skew what's going to happen with implied volatility. However, I continued to hold the trade a little bit over another 30 minutes or so, and then you guys can see now the P&L ended up jumping back up as the 0 DTE implied volatility started dropping. So it was no longer as high as it was earlier. It went to 19.24, which is not good for a calendar. You don't want your front month's implied volatility to increase. This is probably bad for me to do this while I'm still live in the trade because this is kind of scary. Again, this is just option strat, so this is not the actual position here. The actual position is on Thinkorswim. But if we were to just switch to today's IV, if I were to increase this, you guys can see what will actually happen to the T+0 line. So you guys see, let me just reset that. I'm going to increase the implied volatility for today. You see what's happening to the profit. It is actually shrinking. So that's horrible. So that makes me uncomfortable doing. So I'm just going to reset that back to what it normally is. Make sure, let me just boost it up and then just reset it. So it's actually what it is. Going to just refresh the page just to make sure it is accurate. And then let's just zoom out here. And let's go to today's close, reset the size, put it back to 3. So that's just something to be aware of if you're trading calendars, and if you're trading these 0 DTE calendars, know that IV is going to be fluctuating like mad, and you're going to see some sort of fluctuations in your P&L, and that is likely what's happening. Then at the top of power hour, we can see what started happening. The P&L started dropping again, and that's just because the 1 DTE implied volatility dipped. It is now 12%. When I first opened the trade, it was 14%. That is a negative 2% drop in implied volatility for tomorrow. That is also what you don't want to happen, because I bought these contracts for tomorrow. I don't want the implied volatility to decrease. The same case if I were to switch over to tomorrow's expiration and I decrease the implied volatility, you guys see what's happening to the profit. So that is also a scenario in which you don't want to occur. The reason I'm demonstrating this is because I'm trying to highlight again, if you're running 0 DTE Iron Condors and you hit a 6 to 10% profit target in under an hour, you're better off just taking your profit, unless you're doing something very risky that I'm doing right now, such as holding the position into the close or into the last few minutes to try to squeeze out a little bit more profit. This is not something I would normally do. Again, in normal circumstances, I'll be taking that profit as soon as I see sometimes even 6%. However, I wasn't at my desk for the entire day, so it made it a little bit easier to hold as I wasn't watching it. Sometimes, if you're watching a position, the moment you see 6%, you're just going to take the profit. Lastly, if we head back to the gamma exposure, I was hoping to highlight again why I'm thinking the SPX is just going to head up to around here, chop, and then head back down here and then chop around. It is largely coming from the gamma exposure. Lastly, if we also take a look at this, we can see that the price right here was hovering around what's referred to as the 0 GEX level or the gamma flip level. It is right where the positive GEX, so all of this is positive gamma, all of this is negative gamma, and then we can see where the spot price is. Let me make this larger again. Spot price is right around here. This just in this area, so just where the negative gamma meets the positive gamma. When all of the positive gamma meets all of the negative gamma, generally in this area, it's kind of a zone. You're going to have what's called a gamma flip. Again, this is just for the 0 DTE expirations. So the gamma flip is going to be switching back from positive to negative, and whenever price is around that gamma flip strike, I'm also going to be expecting price to be pretty choppy. That's what also triggered the thinking in why I wanted to run this strategy. I could have ran a 0 DTE Iron Condor or a 0 DTE Iron Butterfly, but I decided to go with the calendars this time just because I wanted to be long Vega, which is just long volatility. In case implied volatility for tomorrow was to increase, that would have really benefited the calendar, and I didn't want to be short a 0 DTE contracts today, like a Iron Butterfly or an Iron Condor. I wanted something that would have some exposure to tomorrow's expiration, because on the same end, if we were to go to tomorrow's expiration and we increase the implied volatility to tomorrow, you guys can see what can happen to the P&L for today. Obviously, this would be insane if tomorrow's implied volatility spiked this much and today's implied volatility didn't have any kind of spike. It's not a scenario in which I'm aware of that would likely happen, at least in that exaggerated sense. If implied volatility was to increase across the board, this would be great for the double calendars, and that's a scenario to consider. So I just wanted to have some volatility exposure. So this is the Vega right here. I wanted to be long Vega. I wanted to be long theta. The delta didn't really matter. It was essentially borderline delta neutral, which means I was not picking a direction. This is a great strategy to have in your toolkit, 0 DTE calendars. I prefer to go with the 0 DTE double calendars just because it gives a little bit of a wider range, and then it allows me to, instead of getting 10 lots or 6 lots of one single calendar, it allows me to spread that across multiple contracts just to increase that range a little. You do get a slight valley in between that you can suffer some sort of a risk if implied volatility was to really decrease and the market went absolutely nowhere by the close. But you can counter that by going with a pretty tight double calendar. As you guys can see, the separation here is only 25 points between my put and my call side. So 25 points is a pretty high delta contracts, because I opened this when the SPX was at 49.40. So in a sense, I only went plus 10 points to 49.50, and I only went down 15 points to create the put side here, so 49.25, and then 10 points to the upside to give us this 49.50. So I didn't really go that far out the money. I went with maybe a point or two out of the money on the call side and a point or three on the out of the money on the put side, and that gave me a nice wide structure in which I was comfortable with. Also being aware with the gamma profile was I was conscious of the fact that the market could go down to 49.20, so that's why I just gave a little bit more room to the downside. I was just a little bit more concerned that the SPX might sell off to there, because again, if we take a look at price action at the time in which I was opening the trade, we were a little bit below, we had already breached the 2-day anchored VWAP. We had already broken which was the last strong positive gamma strike. However, I was not too concerned that the SPX would keep selling. This is the SPY I use for analysis, but if we just head over to the SPX, this is the range or the zone on the SPX in terms of by expiration today when the double calendar would not be profitable. So this is in a sense what the profile looks like. If price remained between here and here, the trade would be profitable. So as I opened it around here, I gave a little bit more room to the downside and a little bit less room to the upside, but this is in a sense what I was expecting to be my safety area, and I would have expected price to stall out within this area, and that's just coming from looking at the gamma exposure profile and then also being conscious of our opening range. So right here, this 15-minute candle, this is our opening range. This is something that almost every day traders should be aware of. That's first 15-minute candle. Some traders use the first 30-minute candle. The first 15-minute I think is appropriate and works just as well in my opinion, although I have not been tracking the 30-minute opening range in over 4 years or so. These days, I just pay attention to the 15-minute opening range. So the expectation would be price was below the 15-minute opening range. So I was not expecting it to come back up here. It was the fact that we were below this 15-minute opening range. We already saw some weakness to start the week here. So my expectation or my concern was a little bit more to the downside than the upside. If price was above the 15-minute opening range, then I would have had some sort of a different bias, or maybe I would have tilted the double diagonal in a different direction. So I'm definitely going to look to lock in his profits here. I'm going to just journal this. If you guys are curious, all I'm going to do is just copy this here. I'm going to just size this back down to 1 so I can save it in terms of this right here. I'm going to go to just save, scroll down, and then just going to add to my notes the time. So it is now 3:36 p.m. Eastern time. Going to just add the P&L at the time, make sure I log the IV. It's now 11.3. I'm going to just double check that. Let me just save this, double check, because I have been playing around with the IV. Just make sure that's correct. Okay, so it's 17.4. I should just double check this here. I'm just going to make sure this is right. So 17.4. And obviously, again, this is just for my notes. I'm sharing it. You guys use whatever system method works for you guys. And since it's live, I figured I might as well show you guys. I've never actually demonstrated how I'm doing this. I'm just checking my other monitor for Thinkorswim, checking what the implied volatility is. It's saying for the 0 DTE, it's now 16.46%. And then tomorrow it is 12.37%. So it looks like it went up a little bit from about 36 minutes ago, which is great. I'm just going to mark these spots. So that's 49.43. That's where the SPX is currently trading. Save that there. And now I know. Take a screenshot, journal this, going to be closing out pretty shortly, and then I will save this in a folder. So the next time I want to run a 0DTE double calendar, how did it perform the next time? I'll also take a screenshot of what price action looked like, so that way I can reference it. And then lastly, I'll take I'll save in my journal what the gamma exposure looked like, because this is the profile that I might use, or if the profile matches this the next time, then I'll know this is the strategy I will like to run. In terms of risk management, if the SPX broke above the high of day, then I would have decided if I wanted to close out the put side, maybe I would have ran a 0DTE long call butterfly, so something in this area here. I would have taken a look at what other data points we have. If anything was spiking in the gamma profile up here, I might have used a butterfly to just target up here. There would have been other things I would have taken a look at to be aware of, but for the most part, there was no real need to manage this. Or I'll just set a stop loss at negative 6% or negative 8% and treat it as a almost 1-to-1 risk reward ratio, because the probability of success is pretty high. So if I'm looking to make maybe 7 or 8%, I might be willing to let it draw down 10%. And then the expectation obviously would be that you'd be winning more times than you would be losing on a trade like this. If you have a smaller profit target, so something like 5% or maybe even 3%, you'll more than likely be hitting a higher profit target. The market just closed, and I realized there's something else I forgot to point out in this video here. If we take a look at the VIX on the left-hand side, which you guys know is a proxy for implied volatility, as it is based on the SPX options, you guys can take a note of what happened with the VIX here today. This is a day in which implied volatility actually decreased. I opened the position again somewhere around here, so around 11:30 or so. And from the moment in which I opened that position, implied volatility did increase a little bit, but then ultimately by the close, I record this video a little bit around here. The VIX was already down over 2%. And then all the way into the close, the VIX was down almost 4%. So even on a day where implied volatility decreased and I was long Vega, it did not matter for the double calendar, because the 0DTE time decay. And that's the benefit, in my opinion, to running the 0DTE calendars. I've been running calendars for a few years, and I've experimented with all different types of expirations. They're very unpredictable at times because of implied volatility, but it is very reassuring to know that even on days where the implied volatility or the VIX decreases, you can still benefit because the 0DTE time decay. And largely another reason why I was not so worried about the upside, at least earlier in the day, is because you guys know I look at the QQQ in tandem with the SPY. So the Qs earlier in the day, it's hard for the SPX or the SPY to continue increasing or to go up when the Qs are showing weakness. The Qs were below the 2-day anchored VWAP. It was also below VWAP, and that right here, and within the same time frame as around this region here, a bear flag, if you're a technician, was forming on the Qs, a bear pennant, bear flag, however you look at it. This is reading as weakness from a technical standpoint. We are below key structural levels. We are below a dynamic resistance level. In this case, it is the VWAP, it is the 2-day anchored VWAP, and this does not look like strong price action. So knowing that the Qs were weak and understanding the gamma exposure, if we head back to take a look at the SPY, context around the absolute gamma strike, and then also taking a look at the price action and what happens around these convergence is what gave me the conviction to hold a trade like this for a little bit longer. By the close, you guys can see there was a little bit of a spike, but the SPX ended up closing right around, let's see right here, 49.54. And this is what the trade looked like at the close, right about around where the break even was. So if held until the actual close, the SPX options are still updating after the market. All of that profit could have evaporated within the last 15 minutes of the day, and that's why it's not worth it to hold, in my opinion, those last 15 minutes. You're better off realizing those gains and then maybe trying your luck with some sort of out the money, very cheap butterfly, or maybe just going with an out the money option that's going for maybe 10, 20 cents. At that point, you're practically gambling and you're hoping for some sort of a unexpected move in the last 15 minutes of the day, which does happen quite often. So it's not a complete, throwaway of your cash. And then lastly, if you're curious about the drawdown, because I do track my drawdowns mostly for these types of trades, because it is important to know for sizing up. In this case here, the trade was open right around here. There was no real drawdown. I think there was an initial red for about a minute or two, but then this is the P&L throughout the day. There was a little bit of a dip here as the markets made a push around 2 p.m. Eastern time up, but then you guys can see it did not return to the price in which we opened it for. So the P&L continued to remain above the price in which it opened, and that's also what made it bit easier to hold. On days in which you are holding a position green and then it goes red, psychologically, you're more likely to just take profit the next time it goes green. If this is where you open, this is the trade green, this is the trade turning red. Once it turns green on you again, most of us, I know myself included, I'm more likely to just take the profit. However, if the trade never really was red and it remained higher than the price that I opened it, then I'm just going to continue to let the trade play itself out. So that's something that's important to take note of. I believe this right around here was around the 2 p.m. So this is right when the SPX made a little bit of a push here. And then I'm pretty sure the implied volatility also dropped in that push. And then if it was to keep going up, if it did this move right here earlier in the day, then the profit would have been much less than the 8 to 10%. It probably would have been closer to maybe 4 or 5%. So you would have been compromising some of your profits. But at the end of the day, you're risking some profits to potentially make more. In my opinion, again, just take the profit if you're up around 5 to 8% on these 0 DTE type of calendar spreads. If you're looking for consistency and really building out a strong income type of strategy that you can run 0 DTE, I would say aim for 2 to 3% profits. Something that's also important to take note of is I didn't bother to trade the volatile opening session. I waited well over an hour after the market was open and I let price settle in. I took a look at multiple different data points. That's something to also take note of. There's no need to rush into a trade. The same thing like yesterday. Price action was pretty clean once we came down to this area of convergence here and we had a bounce. Same thing. You don't need to trade the opening session if it gives you anxiety. Wait an hour. Sometimes you don't even need to open up Thinkorswim or open up your trading platform until 10 a.m. Eastern time, 30 minutes after the market opens, when there's more information, there's more data, prices settled into certain spots a little bit more. I know that works better for me, especially at times if trading seems to be a little bit more difficult than not. It's often probably because you're trading during a time frame that does not really work for you or a time span that doesn't really match your personality. Okay, now I'm going to jump back to the conclusion that I recorded previously before recording this session. I'm going to wrap this video up here. Hopefully you enjoyed it. Hopefully you learned something, and hopefully this is another strategy that you can add to your toolkits for 0 DTE non-directional trades. Thanks for watching, guys, and I'll catch you in the next one.